Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Sidus Space.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave in the comment section below.
So let's get into the analysis.
We're looking at Sidus Space, and this company is right in the middle of that burgeoning space as a service sector.
Yeah.
It's a really fascinating mix of, fundamental business change and some just incredibly powerful market catalysts.
It is. When you look at Sidus Space, you're really seeing a classic high-growth, high R&D space tech story. We absolutely have to look past the immediate financial.
The negative numbers?
The negative numbers, exactly, and focus on the long-term vision. What's fascinating here is just the sheer ambition of their investment in technology, particularly this push for vertical integration.
And how that has directly let them get into these major defense and government contracts.
Right. Those two things, they're defining the company's future.
That's a great place to start, because that ambition is exactly why the recent financials look, well, messy. Sidus Space is deliberately moving away from its old models toward what they see as much higher margin space as a service.
And that strategic pivot, it's not painless. You see it in the numbers. We saw Q3 revenue decline, which, on the surface sounds bad.
It sounds terrible.
But it was a deliberate choice. They're clearing the decks to focus all their resources on their main offering.
Which all centers around the LizzieSat constellation. We've had LizzieSat 1 and Meta 2 launched this year in 2024, and LizzieSat 3 is already planned for early next year.
And that constellation is the absolute cornerstone of their future. It's where they build their competitive moat. The company calls this space access reimagined.
Which is a fancy marketing term.
It's a fancy term, but it's a textbook case of vertical integration. They control the entire process end to end.
Okay, so break that down. What does that actually mean for them?
Well, think of it this way. They're not some big, slow company relying on a huge supply network. They're more like a small, high-end, farm-to-table restaurant. They own the farm, grow the food, cook it, serve it. They handle the satellite manufacturing themselves, and critically, they built the Orlaith AI ecosystem.
Okay, you mentioned Orlaith AI. That seems to be where a lot of the heavy R&D spending is going.
Yeah.
Why is that specific tech, the Orlaith AI, the Feather Edge hardware, the CLO software, why is that so crucial? What does it do?
It creates agility. It just completely changes the data economy for them. Because they're vertically integrated, they can customize missions and react way faster than, say, a Lockheed or a Northrop.
Because those guys are stuck with their big, complex supply chains.
Exactly. But the AI stack, that's the real moneymaker. Most companies send all their raw data down to Earth, which costs a ton in bandwidth and time.
Right.
Sidus uses its Feather Edge hardware to process the data in orbit. The Orlaith AI then compresses it, analyzes it, prioritizes it, all before it ever hits the ground.
So it dramatically cuts down on latency and cost.
It transforms raw data into high-value, low-latency insights. That's the product. That's the future revenue stream. They're putting the intelligence on the satellite itself.
Which makes sense for long-term scalability. And we're seeing proof this is working, right? They landed that exclusive Lone Star lunar data storage contract.
Yep, that showed commercial credibility.
Yeah.
And then the selection for the SHIELD IDQ, the big one, that proved defense credibility.
Okay, let's unpack this. The financial side. Because when you look at the fundamentals, you see the result of all of this investment. A jaw-dropping negative EBIT margin of minus 676%.
Yeah.
That's a number that makes traditional value investors just run for the hills.
It does. But like we said, for a high-growth space tech company, that huge negative margin tells you less about failure and more about commitment. It's the heavy, necessary reinvestment in R&D, in building out that AI platform.
You're buying future scale now, but the price tag is steep.
And to sustain that kind of a burn, you need serious cash. Which is why the conversation late last year shifted from their tech to their financing.
Right, the public offerings.
They stacked cash through two major offerings late in 2024. One raised $16.2 million at $1.50 per share, and then another one raised $25 million at $1.30.
So over $35 million in fresh funding, just like that.
Exactly. And the purpose was to bolster their balance sheet. They're funding the next phase of development, new products like the VPX onboard computer and expanding manufacturing.
Okay, but we have to talk about the flip side of that cash grab. You can't just raise that kind of money without consequences. Those offerings caused immediate dilution for existing shareholders.
It's a necessary trade-off.
But is it? I mean, how do we know they won't just need another infusion next year and cause even worse dilution? Is the growth timeline really aggressive enough to justify that risk right now?
That's the absolute central question of the investment thesis. Free cash flow is negative, period. They are all in on expansion and R&D over any kind of short-term return.
It's a massive bet.
It is a massive bet that the vertical integration and the AI stack will pay off with a huge revenue ramp up in 2025. The dilution is real, but it secures the liquidity they need to become a scalable data provider that can actually handle these big government orders.
And that reinvestment story leads us right to the catalysts that have investors so excited, because all that spending, it looks like it's starting to pay off. We've seen, what, a 470% surge over the past month?
And 250% in just the last few sessions. It's been incredible momentum.
And the main cause is pretty clear. It's not just the satellite launches. It's the government access those launches enable. I'm talking about the Missile Defense Agency SHIELD program.
The SHIELD program is the headline, for sure, but it needs to be framed correctly. They were selected for an IDIQ.
Indefinite delivery, indefinite quantity contract.
Right, so it's not a guaranteed dollar amount, but the ceiling on this contract vehicle is a massive $151 billion.
Which is just transformative. It unlocks this vast defense pipeline.
It's like getting the golden key. It lets you bid on everything in the high-end defense supermarket for years.
Yeah.
They still have to win the individual task orders, but now they are officially in the game.
And looking at the charts, the market clearly gets how significant that is.
Oh, absolutely. The surge formed clean, higher highs and higher lows. It broke out sharply above that 150 offering price and ran all the way to 314.
So that 150 level is now a key support level.
It's a floor, essentially.
Yeah.
It was established by the institutional money that bought in during those offerings. And speaking of that, we saw CVI Investments and Heights Capital disclose a 7.4% stake right after that December financing.
Which signals strong conviction from some sophisticated investors. They see the potential. Okay, for balance, let's talk about the bearish argument.
Yeah.
A huge surge like that always attracts short sellers. Short interest went up, what, 74%? To nearly 15% of the float.
It's a substantial short interest, yes. But here's the crucial part. You have to look at how easily they can cover those shorts.
The days to cover ratio.
Right. And even with that high percentage, the days to cover is very low. It's just 1.09 days.
Which means the shorts could get squeezed out really fast if there's more good news.
Precisely. It mitigates the risk and actually adds potential squeeze fuel. If a positive task order win or a successful launch announcement hits the wire, the shorts could get burned.
Which leads us perfectly into the path forward. What's the calendar look like for the next 3 months? What should we be watching for?
The next quarter is absolutely packed. We're expecting Q4 earnings sometime in late January or February. The focus won't be on profit.
Right, it'll be on that post-launch revenue ramp from the first 2 LizzieSats.
And how efficiently they use that $35 million in funding. But the critical event is the LizzieSat-3 launch, scheduled for Q1 2025. That builds out the constellation, increases their data capacity.
And then the big one, the potential SHIELD task order wins.
That's the high-impact speculative upside. That's the moment that could start unlocking that $151 billion pipeline. We're also expecting news on the Estray follow-on mission with NASA.
And this is all happening with some powerful macro tailwinds, too.
Absolutely. You've got major defense budget tailwinds, a sector rotation towards space and AI companies. The whole environment kind of favors growth tech companies making these aggressive investments.
So let's wrap this up. What does this all mean? If you're trying to distill all this down, the tech, the risk, the government access, what's the elevator pitch?
The elevator pitch is that the SHIELD award fundamentally changes the company's risk profile by giving it access to massive defense upside. That upside is fueled by the growing constellation and, over $50 million in funding they secured in 2024.
And despite the dilution, the vertical integration puts Sidus Space right at a major revenue inflection point, driven by these Q1 launches and the potential for those SHIELD task orders.
You can approach it 2 ways. As a swing trade, looking to capitalize on these specific Q1 catalysts.
Or you hold it for a few years, betting on the full constellation scale-up and the long-term data as a service model.
We've covered the ambitious tech, the costly but necessary financing, and the huge defense contract driving the market. I think the key thing to understand is the extreme risk-reward profile here.
At the end of the day, it all just boils down to speed, doesn't it? Can Sidus Space convert that massive $151 billion pipeline into real, high-margin revenue fast enough? before the market loses patience. That timeline is everything. Please don't forget to subscribe to our podcast to stay updated.